Welcome, investors. Today, we're exploring the world of gross domestic product, GDP, to understand why it's crucial for your investment strategy. What is gross domestic product? GDP measures a country's economic progress. It's the total value of all finished goods and services produced within a specific time frame. Countries have unique ways of measuring and reporting GDP. Most countries release a GDP estimate at least once a year, if not quarterly. For instance, the U.S. government releases an annualized GDP report each fiscal quarter on top of a comprehensive yearly report. But why should you care? What does GDP measure? GDP takes a broad view, including investments, government outlays, construction costs, and more. A country's GDP typically goes up when the total value of goods and services sold to foreign countries exceeds the value of goods and services that a country is required to import. Foreign balance of trade is a key indicator affecting a country's economic health. Let's explore why it matters. There are three ways to measure GDP: production, expenditure, and income approaches. Each offers a unique perspective on the economic landscape. Real versus nominal GDP. When learning how to measure GDP, there are two main strategies to know: real and nominal. These formulas are generally the same, with one major exception. Real GDP accounts for inflation, while nominal GDP does not. When analysts and investors want the most accurate and realistic indicator of their country's economic progress, they often use real GDP calculations instead of nominal GDP calculations. Why does the GDP matter to precious metal investors? When the economy is growing quickly and the GDP is on the rise, individuals tend to have a higher income and more purchasing power. In turn, more people have the funds to buy gold and other metals, which drives the prices up. At the same time, the opposite also holds true. When the GDP declines or stagnates, income levels dip and discretionary spending slows down. This causes the price of precious metals to dip, as supply often exceeds demand. While this is one theory, it's important to note that the relationship isn't always this simplistic. Some analysts believe the opposite correlation holds, and that there's a negative correlation between GDP growth and the price of gold. As an investor, staying ahead of economic trends is crucial. Understanding GDP can be your key to navigating the ever-changing financial landscape. Don't miss out on the opportunity to get a free consultation. Call 855-548-9606 and talk to a precious metal specialist at the U.S. Gold Bureau.